Welcome to All Things Financial with Jack Driscoll. Each week, Jack takes on all things you thought were hard to understand about your finances and makes it fun, easy, but most of all interesting. From insurance to the best way to save your money and squeeze the most out of the dollars you put aside for your rainy day. And now you have a friend in the money business. Here's your host, Jack Driscoll.
Welcome back again, everyone, to another edition of All Things Financial. What I wanted to go over today is we talk a lot of times in financial planning about taxes and charitable giving in December around Christmas time. And taxes we usually do after the first of the year, sometimes near the end of the year. And then we talk about different things throughout the year. Today I wanted to touch on a lot of different topics, mainly because all the different areas that families and business owners and everybody needs is different. And a lot of the areas of concerns are unique and personalized. So for instance, we have the healthcare benefits, we have the tax deductibility of healthcare, and that's going up from 7.5% to 10% adjusted of your adjusted gross income. And a lot of you, I lost you already in what I just said. Sounds too technical and it's hard to understand. That, folks, is why most people could really benefit from the services of a certified financial planner, because what we do is encompass many areas of financial planning, not just one single area. So you'll hear a lot of people, even on the radio or on the TV, promoting one single maybe tool or vehicle or investment, and all your needs focus toward that one tool, and that's what they're trying to do. Financial planning is a different process altogether. Financial planning is trying to help people on an individual basis or on a group basis, but customize solutions to meet your own individual needs, your own individual goals, and your own individual risks that sometimes you're unaware you even have. So anyway, today what I thought I'd do is talk about a number of different areas. One is, you know how the Liberty Bridge caught fire about a week or so ago, 2 weeks ago now. And, you know, we run into situations that we don't expect. Now, all of us, we normally just complain about traffic, that we have to go a lot of different routes. But when you dig deeper, there are issues here, especially for all you business owners and contractors. My light bulbs have to go off, because what happened to that contractor, and could it happen to you? Could it happen to your business? What are the consequences of that simple mistake? And could you weather that storm? And what storm I'm referring to is not only the damage to a public access, which is the Liberty Bridge, but also the issue of being fined. Could your business, if you're a contracting business, assume the risk and afford the consequence of being fined over over $200,000 a day for every day that bridge is out of commission? Could your business afford that? Could your business afford even the damage and reconstruction as a result of that simple problem? And finally, is your insurance adequate, and does it even cover fines? Because that can bankrupt you as a company. These are some of the issues that we run into on a daily basis, where that company that had that problem might run into only once in its lifetime. So when you think of certified financial planners, you think of only investment assets and only financial planning for retirement. With our firm, it's far more comprehensive than that. So some of the areas we're consulting to business owners, other areas we're consulting to individuals, other areas we're consulting to families, and further areas we're consulting to seniors doing maybe wealth planning or generation planning. So let me touch into that. Generation planning is sometimes multi-generational planning. That means in some cases, we have grandparents, assets, and taxes. So they conflict. Those needs usually conflict. We say we have grandparents. What does that mean? Picture that in your minds. Well, normally when you say grandparents, we either are grandparents or we have grandparents or we want to become grandparents. You picture something. It's usually a certain lifestyle. It's usually a calm and happy lifestyle. It's free of stresses and worries. But that lifestyle, to be able to actually occur, certain things have to be put in place. And then once we get there, let's say we are even successful and we reach that level and we've reduced or eliminated some of the stresses of retirement, which means we have adequate resources, adequate income, we have good health. Because those are really the three critical components in most people's retirement years secure lifestyle. Adequate assets, secure income, and good health. So when we work on those three, we don't wait until we retire to start on any one of those three. So when we look at financial planning for retirees, we're looking there. If we were a single purpose planner, we would say take all of your earned income in your earning years, live on the least amount possible, and pile it away all for your future, and live and eat, exercise and eat a healthy lifestyle. Even starting in your 40s, 30s, 40s, and 50s, right? We'd start very early. But once you get there, if you've succeeded at all of those, sometimes what we look at and we miss are taxes or nursing home expenses, which could devastate, or other health expenses that actually occur because of our longevity risk. You know, back when Social Security was established, the target date for being able to retire and receive Social Security benefits was age what? Age 65, right? And the average life expectancy when Social Security was passed, the life expectancy was 63. So when you look at that system and you look at where we are today, we have early retirement options at age 62, and average life expectancy might be age 85, depending on your age. We have many, many clients, and I'm sure many of you watching and listening have many friends, families, relatives living into their hundreds and easily into their 90s. So we are now planning for, in retirement years, an unprecedented number of years that your money has to last. And then if we're successful, as I say, we might want to do multi-generational planning, saying we want to preserve our wealth or our assets and get them to not only the next generation down, which are our children, but maybe generations below that, which are our grandchildren. In fact, estate planning and multi-generational planning many times will skip a generation, and it deals with specific strategies, generation skipping strategies. And there are tax strategies with that. So we look at this and we say, if we dump our assets or our wealth or our IRAs, which are taxable, to our children who are already doing fine, they're doctors, lawyers, they're already doing well, they don't want additional income, they'll just pay tax. They might, if we'd be open about it and talk to our families, say, get it down to our kids, which are the grandchildren. Skip us. They have low income taxes. Well, I'm going to take it one step further with this planning and say we could maybe do some charitable planning and get some of the assets that we hold as grandparents, let's say, or business owners. So let me stop and talk about some technicalities on planning that can make a lot more of your assets get to your family than will happen otherwise. Number one, you're a business owner. Number two, you own real estate. Number three, you have IRAs. Now that sounds familiar, I know, to a lot of you. Number one, if you're a business owner, there are taxes if you sell your business. You need to think about that. What is your retirement plan actually if you're a business owner? Well, sometimes the plan is, my retirement plan is I'll sell my business. And when you look at that, you say, well, Okay, fine, I'll sell my business. And then something happens like happened in 2007 and 8 that actually your business is no longer there because the economy failed and you happen to be in the automotive industry and the dealership lost its contract. So that retirement plan that you so carefully invested all your time and money in is gone. So that happens to a lot more businesses than you think. Even if you're successful and you have a business, business taxes are expensive when you sell a business. So when you sell small business stock or you sell a business, usually there's a lot of capital gain. So you don't get to keep what you sold anyway in many cases. Another one is, what about if something happens to you and you die prematurely or become disabled? Is that business still a solid asset? Did you inherit, if you're a partner, the spouse's partner, and then you're looking at, or the partner's spouse? It could be either way, and you run into a situation where your business could be ruined. So that requires a buy-sell agreement in advance so that if anything happens to either of you in a partner situation or a stock situation and other people are involved, that you automatically inherit the shares so you keep full control of the business, and your deceased partner's spouse, maybe in that case, receives money. So now we're talking life insurance, or maybe we're talking an asset carve-out. Do you see how complex this gets? This process of financial planning is like a spider web. If it's done properly, we're thinking deep and we're thinking long to make sure that many unforeseen events are prepared, planned, and anticipated so that you're not caught off guard, neither are your heirs. Well, you look at the situation, let's talk about real estate ownership. When we buy real estate, we depreciate real estate typically, if it's investment real estate. And what happens is we get tax write-offs for that. So one of the benefits for owning real estate, investment real estate, rental real estate, has typically always been depreciation. What happens when you finally sell? Well, a lot of real estate owners say, I'll never sell because of the taxes. But if you do need to sell due to health concerns, it may disrupt your plans. So somebody will dismissively say to me, oh, we'll never sell. We'll just wait for the step up in basis. If I die, there will be step up in cost basis and we won't owe tax. And I'll say in that case, wait a minute. You're assuming the step up in cost basis will survive those numbers of years and still exist in the tax code. Because we almost lost it in the early 2000s. We may lose it again. You're assuming you won't get sick and your assets need depleted first or liquidated first to pay your health bills. You're assuming a lawsuit doesn't come in and require the assets get frozen and then the assets need liquidated. You're assuming a lot of things when you dismissively say, oh, we'll just wait for the step up in basis. We don't need to do planning. What does happen if you need to get out of that real estate? Either better opportunities arise, maybe a grandchild's sick, has cancer, something, you want to help them. Now you'll bite the bullet and liquidate some assets you were going to pass on to them. And did you know there's a recapture of depreciation? So when we look at normal income tax rates, you might be in the 15% income tax rate. And as I've talked about in prior shows, if you're in the 15% ordinary income tax rate and you liquidate assets and there are capital gains that need paid, that capital gains rate might be as low as 0%. Remember, I've gone over that in other shows. Unless the capital gains raises your income tax. But until your income tax goes over the 15% threshold, your capital gains rate right now under current code is 0. Then, if you get into the 28% bracket, the capital gains tax rate is still limited to 15% typically. So you say, what's the big deal, Jack, if we need to liquidate the real estate? Well, it's recapture of depreciation because that rate can be as high as 25%. And in addition, there's a 3.8%, as you know, Medicare tax that can be imposed if your income is too high. So it can be 28.8, 29.8. It could be 39. You don't know what it can be depending on your income and from other sources and if you have to liquidate too much too fast. So that's what we do as certified financial planners. We're helping just sit, listen. What are all your concerns? What's your current situation? How complex is it? How simple is it? Some of you may have simple situations. You think they're simple. Nothing's as simple as it appears. But we're here to help uncover, and really, when you look at everything and you uncover all the different nuances that you have, help develop a plan that's a little more solid than the no plan that a lot of you currently have. A lot of people say it's too expensive to have a financial planner, it's too expensive to have a financial plan, or we don't have enough assets to justify needing one. All of those are incorrect, because when you look at the taxes, the situation that you currently have, one strategy might save all the taxes you would otherwise pay, and the strategy itself is less expensive than all those taxes. There are many opportunities here, folks. Back to my charitable example, my charitable planning. We want to benefit a charity, and you might be donating $1,000 a year, or $5,000 a year, or $10,000 a year or more to a charity. It might be in your will that you have that it's willed to a charity. It might be currently on an ongoing basis you're donating to a charity. But in any case, you're typically donating after-tax resources, which means it's just money in your accounts, and you write a check at the end of the year or all throughout the year to help churches or other nonprofit charities. Well, we have actually strategies that sometimes can maximize those benefits. Let me give you a quick example. I have a lot of examples that are used. Number one, what if we were saying, in any case, that you were donating to a charity, and we said, why don't you carve out a charitable trust and donate to the trust? You'd say, what do you mean? Instead of donating let's say $1,000 a year to a charity, instead of donating $1,000 a year to a charity and getting the charitable deduction, which, by the way, most of you don't get. All of you might qualify for it, but most of you don't get. What do I mean? You're entitled to a charitable donation, but that's if you itemize. And if you look at your income tax returns, and especially for people in retirement, yes, you qualify for being able to deduct a donation to a charity, but you might not qualify for itemized deductions. Your standard deduction might already exceed your itemized deductions, which means you're not itemizing your deductions. So you say, are my health insurance expenses deductible? Yes. Are my charitable donations deductible? Yes. Is your accountant still asking for all your property tax receipts, all your charitable donations and all? And then you look on your income tax return and it's standard deduction every year. Your question to your accountant needs, or your tax preparer then needs to be, why do you keep asking for all that information every year and charging me $300 a year when I could be filing a 1040 easy, not a 1040, because I don't do itemized deductions anymore. I don't qualify because the standard deduction already exceeds everything you add up for my itemized deductions. And you'll find out, oh yeah, the return might only be $125 a year fee, and maybe you're still being charged the $300 a year to file a 1040 to go through all that information and find out that you don't qualify for any of those deductions anyway. Back to my point, charitable donation, and you do qualify for the deduction, but you can't benefit by that because you're under the standard deduction. So now, what if you found you had stock portfolios or mutual fund portfolios with deferred capital gains, and you could donate those capital gain assets instead that otherwise you'll owe 15, 20, 25% on, 28% on, whatever your capital gains tax rate is, or your ordinary income tax rate. and you donate those assets instead to the charity, which if it's a nonprofit qualified 501c3 corporation, or nonprofit I should call it, then they don't pay income taxes when they liquidate those assets. So for you to liquidate $1,000 worth of stocks or bonds that would otherwise be capital gain taxed, let's even say it's 15%, your net to donate to the charity out of that sale is what's left over, which is $850. If you donate those actual assets to the charity, it's $1,000. And the charity liquidates the assets and gets to keep the whole $1,000. Isn't that nice? So you get a charitable deduction if you were eligible for it, but they get the full use of the whole $1,000, not just the $850, or you have to come up with the other $150 from somewhere else. Well, let's go one step further. Let's say it's a huge amount of assets. We, as retirees or business owners, have a huge amount of assets. I want to donate shares of, let's say I want to donate my stock portfolio. And I don't want to deprive my children or grandchildren of the use of that when I die. Why not do a charitable remainder trust? Why not do a charitable lead trust? Whoops, what did I just say? Why not do a wealth replacement trust? I just lost you all again, folks. But the reality is these exist. And what they help to do, if done properly, and if it works in your individual circumstance, it may or may not. Business owners, listen up. Retirees, listen up. If it does, it's possible for you, for what you're currently giving to the charities, your current donations might be able to buy you the resources that you could actually donate the whole assets upon death to the charity, or now in a charitable remainder trust, charitable lead trust, wealth replacement trust, and still get assets, those equal amount of assets to your children or grandchildren upon death on an income tax-free basis and a probate-free basis, and have the beneficiary of the trust be your family or whoever you want it to be, and or the charity. And not only that, if it was, you could actually have the assets go direct to the charity and the beneficiary of the trust be your family. And let's say it's $100,000 to the charity, and in the wealth replacement trust, possibly also have $100,000 go to your family, where you only started with $100,000 asset, but you were making ongoing gifts. And by reapplying how those ongoing gifts are made, maybe into other resources, be able to double the effective benefit to both the charity and your family. Folks, this is financial planning. It can be as sophisticated or simple as you want, but the strategies apply. I want all of you to get out, reach out, find out and inquire through a financial planner. Could you benefit me beyond where I can benefit myself? If so, how much does it cost and what would it be worth? All right, folks, I appreciate all of you tuning in to another edition of All Things Financial. I'll be back again next week.
Securities and investment advisory services offered through SagePoint Financial Inc., member FINRA SIPC, and registered investment advisor. Insurance services offered through Driscoll Insurance and Financial Services Inc., which is not affiliated with SagePoint Financial Inc.